In this video, guys, we're going to look at the efficient market hypothesis, why I think it's complete nonsense. Stay tuned. Hey traders, a very warm welcome to you. Okay, so you may have heard of the efficient market hypothesis. Now, if we have a look at the slide I've got for you here, efficient market hypothesis basically says that the prices of stocks, bonds, commodities, or whatever, anything that's traded, has all the information already there, and the price already reflects all the information. So the theory is that somebody can't consistently outbeat the market or outperform the market because everybody's got the same information, and stocks, let's use stocks example here, are priced fairly. So there's kind of three different threads in this. And by the way, guys, listen, I'm not pretending to be a kind of doctorate in finance. This is just from a pure trader's perspective. You're welcome to put your comments in the section below whether you agree or disagree with me. But I just think this efficient market hypothesis thing it doesn't make any sense whatsoever. We'll get to that why I don't think that in a second. But if carrying on the definition of it, supposedly you can't outperform the market regularly because everything's efficient. You've got kind of three streams. You've got weak, semi-strong, and strong, I think they call it. So weak is that stuff's priced in now based on the past. Semi-strong is that any future problems or future good news, it will be baked into the stock at some point. And then strong is something like it's any instant news or any kind of insider dealing even is baked into the price of the stock. So how that works, who knows? But anyway, the point is, this doesn't take into account human psychology at all. The theory is, and I'm taking this very, very broadly, is that market prices are efficient, i.e. the current price is the genuine value of that stock. Now, we know that that is fundamentally untrue. We know where we've seen multiple times, even in history. Let's not even look at individual stocks. Let's look at history. We've seen, bubbles of the tech bubble where stuff was significantly overvalued, and it became clear over the period of whatever it was, a year, that that was the case. And then psychology was, hey, I don't want to be left with a massive loss, I'm coming out. So psychology played a part with the bubble coming in. People were buying stuff that on paper was highly valued, but they justified it based on something else. Now, am I saying that's a bad reason to buy? No, I'm not. But what I'm saying is people were making a decision based on the fact that this thing was going up and up and up and up, and the valuation looked high on paper. These PE ratios were crazy. A lot of these stocks weren't even making any money, but the point was they thought that eventually would make money, so that was when they were putting their money where their mouth is. But then, of course, it turned out that actually it became a supply and demand issue. The demand suddenly backed off. All of a sudden, everyone wanted to sell, and it moves to the downside. You could look at that with Bitcoin, right? Bitcoin almost debunks the theory on its own, because as an asset, you can't value it. There's no value to it. It's a voting system. It's how people believe it's going to be used in the future, whether it is going to be used in the future. It's purely supply and demand. And supply and demand, as we know, is fueled by individual or a group of individuals' desires and goals. I've done a video before, should I say, where we've talked about literally the different people's goals when trading. You've got perhaps small time or small accounted, should I say, part-time amateurs, let's put them in that bracket, who are piling into stocks because they're looking for quick gains. And you've got longer term investors of hedge funds who've got multi-billions to put to work, who are doing a lot more analysis and don't care about short-term gains. If we look at that as an analogy, the stock price starts going down heavily intraday, those guys who are trading for quick gains on a small account are going to be out because they're not interested in whether it bounces 10 days later. They just want to get out and move on to the next one. So they're selling. Whereas you could get a hedge fund manager who's like, well, I don't care because I believe it's valued at X in the future and I'm tucking it away. And so to say that it's efficient, to me, doesn't make any sense, right? It's human nature that drives price. You and I might both look at a stock price. I might think, you know what, that's good value, I'm going to buy it. You might think, you know what, that's awful value, I'm going to sell it. That's how we have a transaction. That's how a transaction has to take place. If everybody thought the same thing, we wouldn't be able to do a deal, because at no point would there be a trade. Because if I thought the stock was going high, which is the only reason I would buy a stock, by the way, right? The only reason I buy a stock is if I thought it was going high, whether I was stock short or looking to go long. And I have to buy it from a seller. So the only reason the seller wants to sell a stock is he thinks it's going to go lower, it's not going to go any higher. There might be some small other reasons, like, you know, we want to capitalize on tax purposes or something else, but fundamentally that's how a market takes place. So if it's ultra efficient, then we are both kind of looking at the information and coming to complete polar opposite decisions. And we've seen too many times in history where the crowd has pushed stuff purely based on supply and demand in one direction, pushed it the other direction. Then to me that can't be efficient, because no new news has come out. The theory would suggest, and again, someone correct me if I'm wrong, but the theory to me, efficient market hypothesis, would suggest that actually all the news is baked into the price, and any new news that comes out, the price responds, and to a certain extent it does. But you get periods of time where news hasn't changed, but the stock price has moved multiple percents, 20, 30, 40, 50%, and news hasn't changed. You see that intraday when there's a lot of kind of tension or attention, should I say, around a stock that's come out with good news. Yes, it comes up, but then it comes back again. So it doesn't make sense that's efficient. It's purely moving on supply and demand. People are changing their minds based on how the stock is performing relative to the news, etc. And so, you know, this may well be something that, you know, a lot of the kind of academics look at. And, you know, my argument would be, well, you probably know the same, that you've seen prices move based purely on emotion and based on behavioral finance concepts. We can kind of go into that in another video, rather than efficient market hypothesis. And the final thing I want to leave you with, guys, is what fuels people's decisions. You know, what fuels one man or woman's decision to buy or sell a stock is it's a different decision-making process, or different fuel to somebody else. And because of that, I think that's what completely debunks the theory of efficient market hypothesis. I think that because people are making decisions for different reasons, that gives a different impact on the stock. One final thing, let's just imagine, you know, there's stories where we've had hedge funds go bust. They've been caught in positions and they've had to unwind their positions purely because the company is about to go bust, or the broker's unwinding it because he's on the hook. Is he unwinding it based on the valuation he perceives in that asset? No, he's unwinding it based on the ultimate loss he's going to be taking if he doesn't get it done quickly. He doesn't care that that's efficiently priced. He needs to get out because of X, Y, and Z. And that, to me, kind of sums up why I don't think efficient market hypothesis is the right way to look at things. Let me know your thoughts in the comment section below, guys. Agree, disagree? What are your arguments for? What are your arguments against? Always open-minded to hear what you guys have got to say. All right, guys, whatever you're doing, take care, keep your risk managed. Bye-bye.